Good morning, everyone. I know it's been a while. I thought we'd do another update with my old friend Des Mayers, just to talk about what's been going on in the stock market, both locally and overseas, the general sentiment and feeling. Des, thanks for joining us again.
Yeah, pleasure.
Des has been in the stock market for how long now, Des?
56 years.
56 years. So
Started in 66.
1966. Wow.
Remember those days very well. The first big bull market boom that I experienced between 66 and 69, followed by an 8-year bear market through to 77. Taught me a lot.
Jeez, I'm sure. That's quite a shock. It was new to the market, but thank you for joining us again. Nice to get the benefit of your many years of experience. And I guess in some ways they say history repeats itself, or what is the saying you use?
History doesn't necessarily repeat itself, but it often rhymes.
It often rhymes. I like that one. So Des, let's kick it off here. Do you see any similarities between what's happening now and in the past? Has this sort of thing happened before? In other words, what we see now is a very loose monetary policy, very low interest rates, and that's really been the theme of the last 2 years or so. And some could argue that is the reason why the stock market has rallied so much after the crash that we saw in March 2020 when the pandemic struck.
Yes, absolutely, Warren. It's quite fascinating to behold what has been happening. And as you correctly pointed out, we've experienced some very low interest rates, historically low interest rates, with the Fed obviously being very active in buying bonds and pushing interest rates to extremely low levels, where effectively money cost very little, if anything at all. And that's where I think a lot of problems are going to come from, because we had a situation where people were able, investors generally speaking, institutional and individual, were able to invest with very little cost of money. So I can just imagine how much money has been attracted to the moving target of the stock market. And of course, at the same time, they were piggybacking on a tremendous stimulation that was underway. And of course, you had a very strong economy to go with it as the effects of the pandemic unwound. And we went into what I would call a frenzy, really a frenzy where share prices went to the sky. And you had a host of investors chasing the market, which became obviously a very lucrative opportunity for them. But like all things in life, these things happen, unfortunately unwind. And that's where I think we are today, with the Fed starting to no longer support, in the sense that they are no longer going to buy back bonds. And we've seen a dramatic rise now in very short-term interest rates. They've moved up. The Fed funds 2-year, the US 2-year bond moved up from about 0.5%, now up at over 2.5% in 3 months. Now that is a dramatic move. That's a dramatic move. You've had the 10-year yields moving up very dramatically as well, the 5-year, the 30-year. So clearly you've had a major change in the cost of money. And that, I think, was the big factor behind the first downdraft of the stock market, which started around New Year, broke down sharply. The Dow broke down, the S&P, the Nasdaq all broke down sharply during January into February. We had a little mini rally and then found another low in March. And then you had a big kick up since then, very big kick up right through now till early April, which looks to me very much like a major rally in a bear market, the first big rally in a bear market, which seems to be tiring and starting to roll over. But I must add, I don't think it'll just give up that quickly. The market has been such a good place to have been. I don't think it's going to give up very quickly. It will try hard, and more people will be involved and break down further until the Fed starts to see that the policy is starting to have a negative impact on the economy. And I think Once that starts to happen, they may start relenting on tightening monetary policy. Interest rates may then, down the road, start peaking, and then we see stimulation again. Now this, I think, has got huge consequences down the road, and of course...
But that's, sorry to interrupt, but I mean, I think the Fed stimulating again will probably only happen in about a year and a half, 2 years.
Yes, I would think
So-
later this year, into next year. I don't know how far out that will be, but events seem to be moving quite quickly these days. And I think your view that it could happen only down the road, I think could be brought forward quite a bit if the economy really starts to weaken in terms of what's happening at the moment.
Yeah, it's interesting because, I mean, at the moment, it seems as though the US economy is pumping. And it's doing
Absolutely.
really nicely. So some of the lowest unemployment rates they've had in many years. So things are looking all rosy and good at the moment.
Typically when markets peak, when everything really looks just wonderful, as you say, very low unemployment, economy growing strongly, it's a great story, and clearly most people will say, well, why shouldn't it continue?
Yeah. Well, I guess the reason why it may not continue is with rising interest rates that could,
Sure.
put a dampener on things, as well as the rising inflation, the rising commodity prices.
Very serious.
All of this could have a negative effect on the economy, on the global economy.
Absolutely. And I think what will aggravate the situation this time is an unwinding of all the gearing that must have taken place while interest rates were heading lower and lower. It became a really very, very lucrative investment strategy to borrow and buy rising equities and falling bonds. We mustn't forget the bond market as well. The bond market, the yields, we've had a bull market in bonds going right back to Volcker's time, back in 1980, 81, when you could have locked in 15% on a long-dated bond. Well, that bond yield came down and down and down, and only recently has that yield started to pick up. And I can recollect back in 1987, I think it was, yes, July 87, you had then July, August, September 87, you had a big pop in 10-year bond yields moving up. I think it was from around 7.5% up to 10%. The stock market initially ignored it. It peaked in late August 1987, dribbled away up for a while during late August, September into early October, and then we unwound with that dramatic sell-off where the Dow fell 22%. I think it was around the 19th of October 1987. Now that all happened as a result of cost of money moving up, and that crack in the bond market, I believe, was the forerunner of what happened in October 87.
Gee whiz. So that's very interesting because that's exactly what's happening now.
Very much so, very much so.
Rising interest rate. But just something I'm curious about, just so I understand, and our viewers understand, if the yields on the bonds are rising, that means that they're selling bonds.
Yes,
is that correct?
absolutely.
But now, if they're selling bonds, could we argue that maybe some of that money is going out of bonds and might go into the equity market?
Yes, I think we will have some money flowing back into the market, and that's why I mentioned earlier that I think that this market is not going to give up very quickly. I think there will be periods of rally like we saw during March into April, where money goes back into the market for a while. That's certainly possible. No bear market goes straight down. We've had some big rallies. I can go back to one of my very first experiences back in 1969, where the market peaked. We had a low in November of 1971. The bear market only ended in the latter half of 1977. Sure. But what was most interesting, certain share prices bottomed already in 1971, while the bear market continued right through until 77. That was locally. Many share prices were up sharply, and that's where the big opportunity comes from in a bear market. Share prices, several shares reach their lows sooner. they provide great value, and by the time the bear market has ended, these share prices are already sharply higher because of the very good fundamentals supporting them. So a bear market, I think, should be relished by most genuine investors. They provide enormous opportunities.
Absolutely.
Enormous opportunities. And just going back to the Dow peaked in 1966 at about 1,000. It tested that level several times. In early 73, it broke through to 1050. Everyone got very excited about the upside breakout, but lo and behold, it was followed by a 45% bear market during the course of 73 to the end of 74. And the poor investors that had bought at the high in 1966 only saw a little bit of a profit by 1983. It took them 17 years to get on the right side, and that was the Dow Jones Blue Chip Index at the time.
Wow.
So that was a fascinating period.
But now, I mean, that is, was that not when the oil price shock happened?
Yes, it did. During the 70s, there was a dramatic rise. There were huge moves. Initially, when we had the Yom Kippur War, we had the oil embargo, we had two big moves. We had moves, I think it was in 72, 73, 74. We then had another Iranian revolution in 79. That triggered another big rise in oil. And then I remember correctly, the Russians invaded Afghanistan as well. And that led to some really exciting times in the gold market. The gold market went from $35 an ounce, went to $200 by the end of 74. Then, lo and behold, found its way all the way back to $104 in August 76. And then with the oil market story and the Arab embargo and the Russian invasion, the gold price ran up to $850 an ounce in January 1980 before that market ended. So we've had some huge ups and downs.
That's fascinating because, I mean, as you said earlier, history repeats itself, or it certainly rhymes, and it does sound very similar to what's happening now. We've got the Russians invading the Ukraine. We've got an oil price shock now.
Absolutely.
And, that could potentially precipitate another fall in the market.
In the stock market,
especially
yes.
when the Fed is not stimulating.
Supportive, of course.
They're not supportive anymore. So.
Yeah. Change in monetary tactics. Certainly, while this is in play, I think equities, generally speaking, are going to be under pressure. But at the same time, this I think is extremely important. The gold market could be coming to life. And as I mentioned to you a little bit earlier, the move that we've seen in gold in recent times could be only the initial start of a much bigger move. If we look at the gold price on a log scale, go back in time, we'll see that the move we've seen more recently is really a tiny move in relation to the two previous moves that I mentioned to you a little bit earlier. That we could find a gold price, never mind stopping at $2,100, $2,200 an ounce, we could see a gold price up at $3,000 an ounce, if not higher, in time to come.
Sure. Wow, okay. But I mean, that usually happens when the rest of the equity market is falling.
Yes, that's why I think there's the very shrewd players have basically, some of them have gone short of equities and long of gold. So to benefit from a falling equity market and a rising gold market, this could become a very, very interesting play.
Oh, that's fascinating, Des. So look, I kind of agree with you. I think without the support of the Fed, it's going to be difficult for the stock market to find legs overall, except for certain sectors. At the moment, the commodity players are doing very well. The oil and energy areas are doing very well. But the rest of the markets might struggle a bit.
Very much so. Well, I mentioned to you a little bit earlier that I remember back in 1969, the coal shares were completely out of favor, trading on high dividend yields at the time. And while the bear market and the equities proceeded to go down and down, these coal shares, I remember Transnatal, SA Coal, had huge bull markets at the time. And when those prices rose dramatically while a bear market was unfolding.
It's fascinating. So I think that is the point. When we talk about the market coming down, I think you got to be selective about sectors. Because,
Absolutely.
not all sectors will perform the same, and some sectors will do well, and other sectors will not do well. So I
very
think
much so.
in this scenario that you're painting, this fairly bearish scenario, you're still suggesting that some sectors, most of the market will come down, the retailers, the financials, the broad market, but the exception might be the gold shares and any other sectors that you think?
No, I think I'd rather be company specific, because often the saying is that they throw out the baby with the bathwater, and one's got to be on the alert to look for these stocks that may not necessarily not have participated in the huge bull market. And those shares, we've got quite a few that have been really dogs along the way. I don't want to mention too many at this stage, but there's certainly been dogs. And at the same time, these type of stocks provide enormous opportunity if you've done your homework. If you've done your homework, and these shares are on fairly low multiples, reasonable dividend yields, they will perform well even in a bear market.
Interesting, yeah. I think
Absolutely.
And some might argue, okay, we've been talking largely about the big macro themes and what's happening, especially in the United States. But what about back home here in South Africa? I think a lot of people would argue that the valuations on many South African companies are actually still pretty cheap and inexpensive.
Yes, absolutely. I think on a relative basis, we will not escape the macro picture at all. We certainly can't. But I think it'll be far more muted here locally because of the very point that you've made, that because our valuations are not excessive, one will have to be careful that some of the valuations may look very attractive at the moment, but they may be on the back of very, very high revenue resource prices at the moment, which may not be sustainable. It's very difficult. One's going to have to be extremely careful to weed out the areas that have run too hard during the bull market and areas that have been muted or been left alone. And that's where the big opportunity will come.
Yeah, I agree with that. I mean, I think we certainly have seen a very strong resources run.
Absolutely.
Commodity prices going through the roof. And I think that's been largely precipitated by logistics constraints caused by the COVID-19 pandemic, logistics bottlenecks. But one would imagine, and then that also created a backlog in production, but one would imagine over the next year or two, things might start normalizing sooner or later, and that could hopefully alleviate some of these...
In the shorter term, yes. I think that the resource shares, which have been a fantastic place to be, may also come back to some extent, and then we could see a renewed bull market in these shares down the road because of the right fundamentals for them. And I'm just looking at the gold shares, for example. These have hardly participated, and if we look at it historically, the shares in relation to the gold price have hardly moved. And the most interesting thing is that very few investors, be it the institutions or locally, have even looked at gold shares. If you listening to most of the webinars, most of the these discussion groups have not even focused on gold at all, which I think is very, very interesting. Yeah. Very interesting.
But isn't the reason for that because the gold is often seen as a currency, and it moves in the opposite direction to the US dollar. So we've seen the US dollar getting stronger, therefore gold should get weaker, right?
Not necessarily. We can go back in time. This is a very interesting point. You can go back in time and find that notwithstanding a rising dollar, we've had a good gold price, certainly along the way, pretty often. So I'm not too concerned the fact that we've got a fairly buoyant dollar at the moment. That dollar may continue stronger for a while longer, but equally it could backtrack as well. We don't know. But I would not believe that the rising dollar is a threat to a pickup in the gold price. Certainly do not believe so. And even rising interest rates in the 70s, we had rising interest rates and we had a very strong gold price. So it doesn't, as we say, it doesn't necessarily follow.
Yeah.
Doesn't necessarily.
No, I did read a report that showed the performance of the different sectors during previous periods of high inflation. And I think they did mention that the sectors that performed best during periods of high inflation and high interest rates was number one, energy.
Yes.
So that's the oil shares. Locally, it would be Sasol, offshore, ExxonMobil, Shell, etc., BP, and then gold shares. They said as well.
Absolutely. And we don't have many here. Just from a local point of view, I think we've got a half a dozen gold stocks. Going back in the 70s, I think there were 40 or 50 gold stocks listed. So the demand from a local investor point of view is, if when it does come through, it's going to be crammed into half a dozen stocks.
Sure.
Obviously, there are many more listed overseas, right, and those have equally been fairly depressed as well.
Yeah. Fascinating.
Yes, I think that we are in for some most interesting times, and I think that people on the alert who've built up big cash reserves, I think will relish the opportunities that will come their way. And as I've always believed, bear markets are a great place to plant the seed for the new harvest. As long as you don't dig up your crop every night to see if it's growing.
I like that one. Lovely, absolutely. Because as we've discussed before, patience really does pay.
Absolutely. That is a thief that comes to really make life difficult for an investor. They've got to be able to see through difficult times, take advantage of a declining bear market, and don't necessarily believe that your entry level, while it is very attractive, will be the low. I've seen share prices fall 30, 40, 50% from what was regarded as great entry point from a value point of view, but a bear market goes lower than you ever thought, and the bull market at the same time also goes way above where you think a stock is expensive. One's just got to ride along with it.
Absolutely, absolutely.
And discipline. Discipline, all along. Vitally important.
Well, yeah, I think people often have the urge when they see their portfolio going down and down and down, and a lot of stocks in the red and negative percentage returns, feel the need to panic, and that's when they sell. But I guess that's the absolute incorrect thing to do. Rather be patient, because if you do sell when it's negative, then you actually realize the loss. But on the other hand, if you're sort of a shorter term trader, and you've got a strong conviction that the markets might crack now, you could possibly look at going short.
Oh yes, absolutely. There have been so many opportunities with a stock that unwinds from a big bull market. There are some really great shorting opportunities, but obviously you've got to have the courage of your convictions to go with it at the time, and if you're on the wrong side, it can be quite painful. Absolutely. When you have one of these bear market rallies and you are short, thinking that the stock is going lower and lower, and meantime in the short term it picks up against you. Yeah. That's not pleasant at all.
Especially if you've got a geared position.
Absolutely, absolutely. And often the latter stages of the bear market often take place with the unwinding of geared positions that were built up during the previous bull market.
Yeah, fascinating.
Oh yes, absolutely.
Well,
that's why I hope to have many more years in the market. 56 may only be a start.
For us too, Des, we certainly hope that you'll have many more years in the market, and it's always fascinating and always interesting to see what happens next.
Absolutely.
Let's see what happens next, and see if it pans out the way you expect it to.
Yeah. Well, as I said, one doesn't necessarily have to be. It's difficult to be right all the time, but if one is disciplined and follows a good, strict investment policy, one will be very well rewarded in the longer term.
Absolutely. Well, thank you, Des, and on that note, I'd like to thank you again for your time and your sharing your wisdom and your knowledge over the years that you've experienced on the stock market. And
I'd like to add that even though I've been this while in the market, I come in every day willing to learn, because you don't stop learning in this game. that is very important. Be open to continue to learn.
Absolutely, and you know, every day unexpected things happen.
Absolutely.
You cannot predict the future.
No.
That's the one thing we know.
Sure.
Thanks again, Des, and hope you have a good long weekend, and
Lovely.
we'll pick it up. We'll do it again sometime soon.
Sue, look forward to that.
Okay.
Thanks so much, Warren.
Thanks,
Good.
Thanks,
Bye-bye
guys.
for now. Bye-bye.
If you need to discuss any of this, or you want to give me a call, it's Warren at AfriFocus Securities, and my email address is warrens@afrifocus.co.za. That's warrens@afrifocus.co.za. Feel free to drop me a line, any questions you may have at all. Have a good weekend.